Current market status, closed. Last closing price, $10.09 USD. Market movement, down 5.16 points, or negative 33.84% for the session. If you are looking at your portfolio right now, specifically at Fermi Inc., ticker symbol FRMI, you are staring at a sea of red that feels less like a market correction and more like a crime scene. We are talking about a stock that has been absolutely decimated, shedding over a third of its value in a single trading session. When a company loses 33% of its market capitalization in a matter of hours, it is not just a bad day, it is a complete shattering of the narrative that investors have been clinging to since the IPO back in October. The expectation was clear. Fermi was supposed to be the picks and shovels play for the artificial intelligence boom, a safe harbor for everyone from the retail trader on the Robinhood app to the institutional giants managing Fidelity mutual funds. The story was simple. AI needs power. Fermi has the land and the nuclear ambitions in Texas, and therefore Fermi is the next big thing. That was the expectation. The reality, as we are seeing with this gut-wrenching drop to $10.09, is that infrastructure is hard, contracts are fragile, and when your first major tenant walks away, the floor falls out from under you. Let's break down exactly what happened, because if you are holding this stock or if you're thinking about buying this dip, you need to understand the mechanics of this crash. The catalyst for this 33% plunge was a filing that hit the wires late last week, an 8K disclosure that revealed Fermi's first prospective investment-grade tenant has terminated a massive funding agreement. This wasn't just a handshake deal, this was an Advance in Aid of Construction Agreement, or AICA, that was supposed to funnel $150 million directly into Project Matador. Investors had priced in that $150 million as virtually guaranteed. It was the proof of concept. It was the validation that Rick Perry and his team weren't just securing land in Amarillo, but were actually signing checks with big tech heavyweights. When that tenant pulled the plug, terminating the agreement before a single dollar was drawn, it sent a shockwave through the market that we are still feeling right now. The selling pressure has been relentless, with volume spiking to levels we haven't seen since the debut. You can see the panic in the order books. Retail investors on SoFi Active Invest and Robinhood were likely the first to hit the eject button, reacting viscerally to the headline, "Tenant Exits." But here's where things get interesting and where we need to separate the emotional reaction from the fundamental reality. The market is pricing this as if the entire business model has collapsed. But has it? The stock is trading at roughly half of its IPO price of $21. The market cap has evaporated from over $12 billion to just around $6 billion. And yet, if you look at the analyst notes coming out of firms like Stifel and UBS, there's a strange disconnect. They aren't downgrading this to a sell, they're holding their price targets steady in the high 20s and 30s. Why? Because the reality that the smart money is seeing is different from the panic we see on the charts. The land is still there, the grid connection with XL Energy is still there, the demand for gigawatt-scale power for AI training clusters hasn't gone away just because one tenant got cold feet or tried to renegotiate terms. This tension between the retail panic selling we see on interactive brokers and the steadfastness of the institutional analysts is the single most important dynamic to watch right now. Let's look at the psychology of this sell-off. When a stock like Fermi, which is essentially a pre-revenue development stage company, takes a hit like this, it exposes the fragility of story stocks. Investors weren't buying cash flow, they were buying a vision of the future where nuclear reactors in Texas power the next GPT-5 or GPT-6. When you buy a vision, you're buying hope, and when that hope gets punctured by a boring, legalistic termination letter, the reaction is disproportionate. We saw massive blocks of shares being dumped throughout the day, likely from Fidelity wealth management accounts or similar managed portfolios that have strict risk parameters. If a stock drops 20% in an hour, their algorithms might automatically trigger a sell to preserve capital. This creates a cascade effect, a self-fulfilling prophecy where selling begets more selling, driving the price down to this $10.09 level. It's ugly, it's painful, but it's also mechanical. It's the sound of leverage unwinding and risk models flashing red. However, we need to ask the hard question: was the tenant leaving actually a disaster, or was it a negotiation tactic that Fermi management refused to bow to? Some reports suggest that the tenant tried to change the terms of the deal at the last minute, and Fermi management, led by Toby Neubauer, decided to call their bluff. If that is true, then this 33% drop is a massive mispricing. It would mean that management is confident enough in their pipeline of other tenants, the ones they say they are talking to for 2026 delivery, that they were willing to let $150 million walk out the door rather than set a bad precedent. That's a high-stakes poker game, and right now the market thinks Fermi lost. But if they announce a new tenant next week or next month, this stock could rip back up just as fast as it fell. This is the volatility you sign up for when you invest in high-growth, high-risk infrastructure plays. It's not like putting your money in a boring index fund via Schwab Intelligent Portfolios. This is the Wild West of the energy transition. Let's step back and look at what Fermi actually is for those who might be new to the ticker FRMI. This company is trying to solve the biggest bottleneck in technology today: power. We are running out of electricity to run the massive data centers required for artificial intelligence. You can't just plug a gigawatt-scale data center into the normal grid without causing blackouts. Fermi's solution is Project Matador, a massive off-grid energy campus in the Texas Panhandle. They've leased over 5,000 acres from Texas Tech University. The plan is to build natural gas plants, solar arrays, and eventually small modular nuclear reactors using Westinghouse technology. It's an incredibly ambitious plan. It involves former politicians, massive construction projects, and regulatory hurdles that would make your head spin. But the prize is massive. If they pull this off, they become the landlord for the most valuable companies on Earth. They become the utility company for the AI age. That's why the IPO was so hot. That's why people were comparing it to buying Tesla stock in 2012 or Nvidia stock before the crypto boom. But infrastructure is capital intensive. It burns cash. Fermi needs billions of dollars to build this out. The $150 million from the tenant was a key part of that early liquidity. Without it, they might need to raise more cash, which means diluting shareholders. If they have to issue more stock at $10 a share, that's painful for anyone who bought in at $20. This is the risk that is being priced in right now. The fear is that Fermi will enter a death spiral, where a lower stock price makes it harder to raise money, which delays construction, which scares away tenants, which lowers the stock price further. This is the nightmare scenario that every user on SoFi Active Invest forums is discussing right now, and it's a valid fear. When you're building something this big, you need momentum. Friday's news killed that momentum dead in its tracks. Now let's talk about the broader sector context. Fermi isn't operating in a vacuum. The entire AI energy trade has been under a microscope. We have seen volatility in other nuclear names and utility stocks, but Fermi was supposed to be special because of its behind-the-meter approach, meaning they generate power on-site, bypassing the congested public grid. This is still a massive competitive advantage. If you're a hyperscaler like Microsoft, Google, or Amazon, you don't care about Fermi's stock price. You care about whether they can give you 500 megawatts by 2027. If the answer is still yes, then the stock price is irrelevant to the fundamental business value. In fact, a lower stock price might make Fermi an acquisition target. Could a major utility or even a big tech company decide to just buy Fermi outright to secure that power for themselves? It's speculation, sure, but at a $6 billion valuation, it's bite-sized for a company like Apple or Microsoft. That's the kind of lottery ticket upside that keeps people holding through the pain. I want to pause here and ask you a question because this is crucial to how you view this stock. Comment below. Do you think the departure of this first tenant is a fatal blow to Project Matador, or is it just a bump in the road? I want to know if you think management was right to let the deal collapse, or if they should have taken the money at any cost. Let me know your thoughts in the comments section. Moving into the future outlook, we have to look at the catalysts on the horizon. The most immediate thing to watch for is the next 8K filing. We need to see if they announce a replacement tenant. Management has hinted that they are in talks with multiple parties. If they can announce a new LOI or a definitive lease with a different investment-grade entity before the end of the year, this stock could re-rate significantly higher. The other catalyst is the Department of Energy loan application. Fermi is applying for billions in low-cost government financing. If that comes through, the loss of the $150 million tenant funding becomes a rounding error. However, if the DOE gets cold feet because of this news, then we have a real problem. The political connections of Rick Perry are supposed to help here, but politics is a fickle beast. We also need to consider the technical damage on the chart. Smashing through the IPO low of around $12 or $13 is bearish. Technically, there is no support